Welcome, my friend, to this volume trading strategy video. I'm going to share with you one of the basic meta patterns of volume and price. Price volume trading strategy, how volume and price intersect and interact with each other. So one of the most basic patterns, this is like volume lesson 101, but it's a good one and everybody should know this. And it's a good reminder for those of you who perhaps haven't watched this for a while. All right, so here is the basic pattern. It's very simple. And what we're going to do, first of all, is identify the general level of volume. What's kind of an average level of volume here on this market? So let's see. We can put it in right about here. Guess, yeah, we're just trying to capture, where normal volume goes the vast majority of the time and then catch some of these breakouts that are exceptions. And you could also do this with a moving average, by the way. A lot of people like to put a moving average on their volume histogram, and that's okay. The only reason I actually prefer to do it this way is that I think it a little more accurate in the sense that you can give it a little more room for wiggle room, and you can eyeball it to capture that. The moving average is convenient because it automatically plots for you, but it's also incorporating, and it's lagging, actually. It's lagging. So anyway, either way is fine. If you have a preference, no problem. So anyway, here is the basic pattern. So as price moves up, as we get an impulse move up, we want to ask ourselves, okay, is that a strong move up or a weak move up? And then we want to also ask ourselves on the retrace, is that a strong move down or a weak move down? So if we're going to go long, what we want is a strong move up and a weak move down. We don't want there to be a lot of buying coming in, followed by a lot of selling right away. That's what creates the V patterns, V tops, V bottoms. So in other words, we want the buying power to stay strong, okay? So what we get then on the price histogram here is, sure enough, as price is going up, it breaks out of this volume range. And then as we get our retrace, it goes back into the volume range and stays down there. So that is how we measure. That's specifically the how to determine whether there is strength up, first of all. That's step one. And then step two is the retrace on selling strength or on selling weakness. And if it's on selling weakness, then what that really translates to in real life, behind the scenes, is it means that there's not a lot of short selling from institutions and big players. There might be some retail shorting. That's fine. That's not going to affect the market turning around and going down very much. And there might just be a lot of profit taking, and that's fine too. So if that's the case, then that's the kind of pattern we want to see if we want to buy a retrace in a trend. And so then we say, okay, still interested in staying on the long side of this. So as the market moves up, puts in another impulse move up, what happens? We get above that range on the impulse move up on volume. So great, now we've got a strong move up. Alrighty, so everything's still good, but that's not enough. Now, if we're going to add to our position, or maybe we didn't get in on the first retrace, and now we're looking, and we only identify this later, so then we're going to ask ourselves the exact same question. Now, look, price goes down quite a bit, right? So if you're just looking at price, you say, wow, that's a pretty steep retrace. The retracement there, percentage-wise, is a lot. But then we go look at volume, and we say, yeah, but there wasn't a lot of selling volume. So selling volume went back into kind of just the average range, which means pretty much nothing. That's just kind of the status quo. No, not strong up, not strong down, just kind of hanging around, right? So therefore, that's why it's important to not only look at the price pattern, but also at the volume pattern to see how strong or weak that selling is, because the selling could look dramatic. Now, if you put Fibonacci on here, in fact, well, we don't need to do that, but because if I do that, that's going to take away all of these drawing tools here, and I want to keep those on. Next move, alrighty, goes up, and what happens to volume? Goes up on strength. Now, that's the strongest volume that we get, right? It goes above these two highs on volume and makes the highest high, but it's also at a place that we're now kind of in an extended trend. And you know the slogan probably, the trend is your friend until the end. What that really means is that we should only trade trends early in a new trend. So the trend is your friend until the end is really a timing slogan. It means the longer the trend continues, the less likely it is to continue. It can be challenging to know when that trend will end, but I'm going to actually address that in this video real briefly. So actually, maybe we'll do that in the next video. Yeah, I'll tell you what, we'll do that in the next video. We give that its own time. So right now, let's just do this one topic. And then in the next video, I'll show you how to look at the same kind of patterns for trend reversals. But here's basically the deal with this. So we'll get a 1, 2, 3, 4, 5 pattern. All right, I'm not talking about Elliott waves. I'm just talking about these impulse moves and retraces. So in my trading methodology, I prefer to only trade the first 2 retraces in a trend. And that, again, is just to follow that rule. Now, it could go further than this, but the odds get diminished. And I want to trade with the odds. I don't want to trade outside of the odds. I'd rather take my money and look elsewhere for a high probability trade, meaning early in a new trend. So now, the problem too is late in an old trend, you can also get a big impulse move on volume, and it can be an exhaustion pattern. Again, that is more likely to happen late in an old trend than it is early in a new trend. So it can also, this is where it gets a little tricky, it can be a trend ending signal, especially after we've been going on for a while. Now, this one actually turned out kind of nice and kind of neat and didn't cause any problems because at this point, then, the market puts in a low, a high, a low, a high, just kind of goes sideways for a while, right? And again, that's indicated with volume. So this whole time volume stays, how should I mark this? I'll just do it this way, I guess. Volume stays down in that range. So in other words, there's none of these impulse moves where the market goes up. None of them are accompanied by big volume. None of them. None of them break out of this volume range. And that's what would tell me that, oh, probably these are not going to be big moves, and they're not. They're not. And so this is a great meta pattern. This is really the first volume pattern that I think everybody should learn. There are always, some exceptions to the rules, and you can get into that later, but you got to start with the rules, and then you'll learn the exceptions. So this is something everybody should understand, know, memorize. I mean, it's pretty simple. It's pretty logical, and I think it's within everyone's grasp to get this. Works on day trading, swing trading, stocks, commodities, options. I would say it works somewhat on Forex, although you have to be careful with Forex because Forex uses tick volume, and it's also not a centralized exchange. Day trading, I would say, again, it does work, but day trading, it doesn't work quite as well as with daily bars because day trading has a meta pattern of volume built into it that you have to overcome and trade outside of that meta pattern. I've got another video on YouTube if you're interested in that. But this kind of basic pattern can still be seen in day trading, still be seen in Forex trading, but ultimately trading this on daily charts with stocks and futures, commodities, things like that works fantastic. All right, well, if you thought the video was good, if it was helpful for you, then share good things with good people. Go ahead and click the share button below. Also, share your comments. I love your comments. If you have any questions or even requests for videos in the future or topics, put your comments down below. Your comments are really, I love them. I read every single one of them, by the way, and it keeps me motivated to continue to create more free tutorials for you. And finally, I have a trade strategy I'd love to share with you, and this one is a complete trade strategy. I mean, including the entries, the exits, where to place your stops, everything. And I can't do it in a 10-minute YouTube video, so I've created a little mini course for you. That course is absolutely free. This is called my rubber band trade. Feel free to click on the link in the top right corner of this YouTube video, and you can get access to it there.